Well, hello everybody. Francisco Sirvent here with Lifestyle Planning, and it's been a crazy week in the markets. So I wanted to bring to you some of the research we use in our own practice and why we completely believe in the philosophy that we advocate, that we implement for you, our members, and give you some of the fundamental science and research behind why we do what we do, because it's literally times like these that can make all the difference. And if we can help save one member from if we can help save you from making one bad decision in times like these, it can make the difference in forever. So let's look at what we've got. Dimensional is a company. We use their funds for our equity and ETFs. And I'm not going to go through every slide here, but they have some really good data points that I want to go over with you guys. Obviously, inflation eats away at the cost of everything over time. The biggest focus that we always come back to is, what does the market do over the long term? We only position a part of your entire portfolio, some part, into the stock market, the portion that we know you don't need immediately. It's a longer term play, and that's where investors are rewarded with stocks. Okay, so that's what this chart shows. You guys have all seen how the stocks have done over time, and they go up and to the right. You see the bounces. I want to focus in on this one because there's ups and downs. The red are the bear markets, okay, and the blue are the bull markets. But you can see that after each bear market, each bear market is pretty small. There are these big, very positive bull markets. This is what the market does. And I believe the reason for these blips is less so right now a factor of economic indicators and more so a factor of news headlines. Economic indicators are still good. Um, Let me jump ahead a little bit to just a reminder. These were all news headline crises all the way back to 1970. Big things, some things that really, really felt like the world was crumbling down around us. I mean, how many of us, we remember COVID, we remember Brexit, we remember when the real estate crisis happened, we remember when the subprime mortgage, I mean, right? I mean, the subprime mortgage was a financial disaster by a lot of respects. But we look at where the market is still in comparison to that. We look at the 9/11 terrorist attacks. The market comes back. This is just a really good data point. We tell all of our clients that whatever portion is in stocks, we expect, because this is what the data shows, not my guess, but the data shows that out of all the years from 1926 to 2024, there have been 74 positive years and 25 negative years. So basically, 1 out of every 4 years, we expect the market, that portion is actually going to lose value. You're not losing shares. You still own the same number of shares. You're losing the value, but we're not selling it down. Okay. This is the key takeaway. Studying investments and investors, if you stay in the market, even through the bumps and the down years, if you stay in, because we don't know exactly when the market's going to correct. I mean, nobody has that crystal ball. So if you just decide to stay in, weather that storm for that portion of your portfolio, if you stay in the whole way, growth of $1,000 from 1990 to 2024 grew to $34,000. If you just stayed in, you just rode the bumps. But if you decided, I can't handle it, this portion is down, and you jump out, you go all cash, and you happen to miss the next day, which was the one single best day in the market during that time period, your count didn't grow to 34, it grew to 30. If you missed the best 5 days, all the way down to 21,000 just by missing 5 days in that 34-year time period. If you guessed wrong and just missed those 5 days, if you missed the best 25 days, your account would have only grown to 34,000 as opposed to just holding on. I get it. Hold the roller coaster, hold your rails, and just stomach it. Discipline. You would have made 34,000. The discipline is the key. Okay, the discipline is the key. There's one other slide I want to focus on for you. Um, After a recession, average returns show historically they're positive. So we are still very optimistic. We had a very down year, 2022, 2023, very positive year, 24, very positive year. This year, our best guess is that's going to neutralize. It's not going to be a big year, but it's going to neutralize. And we've even seen that as of today with the big drop on Monday, things coming back today. That's why we advise whatever portion, again, we're only putting a portion in the market that we know you don't need today. You don't need this year. You don't need next year. That's a portion you can wait out. And this data shows after a recession, the average returns are positive. Okay. So our advice